It honestly feels like maybe the most important question and topic in today's market amongst our clients and investors that we talk to that are not clients. People's personal politics are most certainly influencing the way they feel about the economy, markets, the world. And you can't necessarily blame them. It is what it is, sort of thing. But we did a post about this or a webcast about this last year because it was just so evident. We had right-leaning clients that were very nervous about what was happening with the Biden administration and liberal policies and deficit spending that was supposedly getting out of control. And a lot of people either missed out on two really strong years in the stock market, 23 and 24, or were reluctantly invested, which is okay too. But again, and we're going to show a graphic that demonstrates how people that are lean Republican versus lean Democrat, how they feel about the economy, the strength of the economy, and the opportunities as an investor, going back over the last couple multiple presidential cycles. And just to formally address the question, we're absolutely experiencing that now, and in a exact mirror opposite of what we were feeling last year. So now it's left-leaning clients that are incredibly reluctant to make any sort of decision, very pessimistic about opportunities, not just from an investment standpoint, but just what's happening in the world and in our country specifically. And what makes it sort of interesting is that the market doesn't seem to be as volatile as headlines and the emotions that are being generated by these scary headlines. So, but 100% we're having left-leaning clients and left-leaning friends reach out, and they are not at all optimistic about what's happening in the economy and markets. We're getting questions about whether it's a good opportunity to move to cash. We have had some clients move to cash, which has not necessarily been our advice, but this is where the intangibles of being an investment advisor come in, because a retirement plan is only as good as a person's retirement plan is only as good as their ability to endure it and to hold on to whatever the investment plan is. Consumer sentiment just in the last month has taken a huge dive, a nosedive from relatively stable and normal, healthy levels to basically like concern territory. Consumers are as worried about the economy and their ability to consume and buy things like houses and autos and clothing and food as they've been since 2021. So there's uncertainty. And I think what's interesting about this is people are showing this headline and this statistic as if it's a sign of what's to come. Things are going to get worse. When in reality, if we do look at these charts, it sort of works the opposite. So when fear and uncertainty is at its high point, or at least that's what the headlines would have you believe, consumers are most nervous, that's usually when prices in terms of stocks are at a short-term low point, because there's only room for things to get better when sentiment is at a bottom, and vice versa when sentiment is very high, when consumers are feeling exuberant and they're taking out a home equity line to buy a boat or a second home. Oftentimes that coincides with a high point in prices. So I think this is a sort of a contrary indicator, consumer sentiment, or it can be, and it doesn't always work, in immediate terms. But I think it's when I see a headline like that, I don't necessarily get bearish. There's all these old adages. It's not timing the market; it's time in the market, and a lot of these things are easier said than done. Because at the end of the day, we are all human beings and we all need to sleep at night. So we need to be somewhat comfortable with what our portfolios are doing. But what the graphic is going to show is that missing out on just the 10 best days of a year can have a hugely negative impact on long-term returns. And it also just so happens that the best days of the year tend to be clustered around the worst days of the year. Reason being, it's just kind of how it works. When the market takes a dip, and we do have corrections, the market doesn't go up 0.1% every single day. We take the stairs up and the elevator down. And when the market loses 5, 10, 15% in very short order, inevitably there is a little bit of a bounce back. That doesn't necessarily mean we get all the way back to where we were and straight back to all-time highs. But if the market loses 5 or 10% in a week or two, you're historically going to see a bounce. That's going to probably be at least half of that, which indicates those are going to be some pretty good days. You might have an S&P up 2 or 3% day. And if you panic when the market has just taken a dip, you're going to miss those days more often than not. Most people are completely unable to time the market perfectly, which is why things like diversification and rebalancing and having a portfolio you can live with is really important. Yes, of course, 100% equities are going to do better over a very long period of time, but almost nobody has the stomach for that. And we've seen evidence for why that is in the last month. So the graphic is hugely helpful, at least in terms of saying, what are we doing being invested when there's this much volatility? Well, what we're doing is we're trying to make sure we don't make a mistake of missing out on one of these best days. Terrific question, and it's actually something that we've dealt with this exact scenario, where somebody who's not a client, they are working with an advisor who is really sort of telling them in no uncertain terms, stop worrying and just stick with the plan, stick it out, and just sort of showing them statistics similar to the previous question where we showed the not missing out on the best days. However, this is an opportunity for advisors to really lean into the bedside manner of things, because these are uncertain times. There are more opportunities to get scared by headlines than ever before. We're swimming in information and it's all real time. And when the Dow drops 500 points or 1,000 points, you better believe you're getting multiple alerts on your every device that's around you all day long. That could be scary. There's truth to the suggestion that, if we have in fact built a proper long-term strategy for your portfolio, then it ought to be okay. You ought to be okay sitting through a period of a little bit of volatility. But that is not enough for everybody. Some people are overwhelmed a little bit by what's happening, and ultimately we need to cater to that a little bit. And the reality is the markets are doing okay in spite of the headlines, and there are certain things that are working. We've already talked in our last webcast about how international stocks are positive, high single digits this year. Energy here in the United States, domestic energy, financials, utilities, these are all things that are producing positive returns. And the overall broader indexes aren't down that much, just a few percent. This is a really important time to be having conversations with clients and gauge where they are in terms of their comfort level with their plan. If I'm talking to another advisor right now, have conversations with your clients. Ask them how they're feeling. Ask them if, when they turn on the news and they look at their portfolio and it's bouncing around a little bit, are they nervous? Is there something that we can do? There are shifts you can do that can be short-term or even maybe more intermediate term that are not going to be as debilitating to their long-term prospects. And those are the types of conversations we're having with clients who are really in need of taking a little bit of action. And I think that's important right now. Now, this is a better opportunity, I think, for the question of what could go right than the last time we filmed, which was just a month ago. When we filmed our last webcast, things were within 1 or 2% of an all-time high. Headline risk hadn't really started yet, and then immediately afterwards there were one tariff headline after another, and then there was the combative meeting in the Oval Office with Zelensky, and just no shortage of headlines scaring investors about what's coming next. The United States economy ability to withstand some tariffs if they actually get implemented. All of these things have been called into question in the last 3 or 4 weeks, and the market has absorbed it really well. I mean, we're talking about what to do in times of huge volatility. We haven't actually seen huge volatility. We've seen a average drop in the market in a very short period of time. This is not COVID. This isn't even 2022, where we were down well into double digits, and it felt like we were definitely heading into a recession. I don't know if we're heading into a recession. Growth is certainly slowing. That the data is showing that. But if we just go back a month or so ago, there was a headline about GDP. The Atlanta GDP forecast took a huge nosedive into negative territory. And it was like overnight. It was a big surprise, a huge negative shift in expectations. And that scared everybody because it was like the takeaway was the economy is not going to be able to handle the tariffs and the uncertainty and the unknowns. And then we waited a couple of days and parsed through the data a little bit. And in reality, what happened was there was a hit to activity, but it was because companies were getting ahead of prospective tariffs. So a bunch of purchasing and inventory building was done ahead of the end of the year. And so that showed a data set that was a little bumpy. So it's not that we were thrown into a recession or a depression overnight. It was just that data was bumpy. And I think what's happening is that the economy is sort of showing how resilient it can be in the face of some uncertainty. So what can go right, similar to how we answered the question last time, we may muddle ahead. We may get a year of slowing, but positive growth. Markets may not do gangbusters, but it may be positive. We may end the year positive. And this is not a prediction, but if we were up between 5 and 10% for the year, I think most investors would be thrilled, especially after how 23 and 24 went. So what could go right is just some of the fear that has been injected into investors in the last month. Maybe some or all of that doesn't come to fruition. And whether that is in the way of tariffs being used strictly as negotiation tactics and they don't end up actually getting implemented, or maybe there are some additional tariffs on China, but not on Canada and Mexico. Just additional clarity, I think, from the current administration will go a long way. And I think investors could potentially settle down if headlines and the little bit of volatility we've seen settles down.